What is an IPO and how does it work? An IPO refers to the process where a company does an initial public offering, an IPO. They're basically issuing and selling their stock on an exchange to the public for the first time ever. When companies are founded, when companies are started, they are owned privately. When I start my company, whether I'm a plumber, a manufacturer, or a wealth advisor, I am the sole owner of my company. On day one, it's myself, perhaps my spouse, perhaps my parents gave me some capital, but that's it. Very small group. As the company grows, typically you'll need capital. You will get friends, family, buddies, they put some money in. Over time, you might go see an angel investor or venture capitalist and you're maybe getting an influx of capital here and there, but it's still largely friends and family. Over time, you continue to grow, you get more capital. There are some select groups that have funded your company, and now it's owned perhaps largely by my friends and family, perhaps a few angel investors, perhaps some corporate or venture capitalist investors as well. And now the company is large enough, we want to have access to capital so that we can grow our company. We're going to list our company's shares on an exchange, and we're also going to raise some capital to do that. So we're going to issue some shares. Institutional investors will typically buy those shares, and then another chunk of shares will be sold on an exchange to be freely traded forever. Companies need to meet the requirements of the regulators and the exchanges before they can ever do this. It's a long process. It takes months and months and months, and you need to have all your ducks in order before you could ever get to filing an IPO on an exchange. One of the neatest things about the IPOs is that they allow a company access to capital, because down the line, once you're publicly traded, now you can go back to the market. You can go back and say, hey, we need another $50 million or $500 million, and we do a share offering and we issue more shares, and then people can buy those shares. And it's the easiest way to access liquidity, to access capital. And companies that are in growth mode, they need capital. They need capital to grow. So if you're private, what are your choices? You can go see mom and dad for more money, but if mom and dad are tapped out, your other options are going to the bank to get a loan or something like that, but you're not going to get a $50 million at the bank. So, the public markets for companies that are really large and growing and really need capital, it's the best way for them to access liquidity. Companies will hire an investment banker, and they're going to gauge the market. They're going to talk to their clients. They're going to figure out how much they think they could sell and at what price they think they can sell the shares for. They call this book building. IPOs can also be seen as an exit strategy for the founders or for the first family members that have maybe cut a check years and years and years ago and only now finally get to see some sort of profit or some sort of exit from their investment. Because before that, there was no way to exit your investment with a private company. Now, where do companies start to think about going public? Well, they gotta have typically a market cap of $1 billion. That's kind of the number on the street where a company might be known as a unicorn, and it might be like a minimum size for you to start thinking of listing on the major North American indices. So that's typically the number that you'll see. The Dutch are actually credited with the first ever IPO back in 1602 when they offered up shares for the Dutch East India Company for the first time ever, and investors gladly swept up those shares. Since then, IPOs have been used as a way for companies that are private to go public, access capital, offer accessibility to those companies to the public as a ways of investing, and just to participate in capitalism and the profits of some of the largest companies on the planet. Now, what are some steps to the IPOs? First off, proposals. The underwriters will present proposals to valuations to the company. They'll tell them, we think we could raise this much money for you. Are you interested? Do you want to deal with us? There's a whole bunch of proposals that are brought to the company. Next, the company will choose an underwriter. They're going to decide we're going with this company as an underwriter, and they're going to do this entire IPO process for us. Next, they're going to build a team. The team will include the lawyers, the underwriters, the investment bankers, accountants, SEC specialists, regulatory environment specialists as well. Documentation, don't forget, this is a very documentation heavy process. So the company that's filing their IPO must file tons and tons of paperwork, disclosure, all sorts of information about themselves, key shareholders, profits, financial statements, and they gotta do that with the regulators before they're ever able to get their IPO. Then they gotta provide marketing and updates. So the company that's thinking of doing an IPO must on a continual basis go to the press, their social media feeds, they gotta talk about what they're doing, update, You got to create a buzz, because remember, someone's going to want to buy those stocks at some point. Someone's going to want to buy those shares at some point. As you get closer to the date, the board gets involved, the process says due diligence, all the T's are crossed and the I's are dotted, and eventually you get to that point where the shares are actually issued and you have your IPO date. You're going to go to the exchange in New York, you're going to ring the bell, you're going to have your IPO. That moment is when the shares start trading freely on the exchange. And it might be a float. Typically floats used to be kind of 30% of the company. Nowadays, they're kind of more like 20%, maybe even 10%. That's the percentage of shares that the company that's doing their IPO is going to put out there as a float. So it might be 5% of my shares, 5% of my partner shares, and 1% of a whole bunch of other partner shares, and we're putting up 20% of the company as a float to sell on the first day. There's a ton of bids that are going to come in, a ton of assets going to come in, and then those shares all sell at that price on the first trade. After that first trade, it's a free-flowing market where there's a ton of bid, ask, and the stock will move. Typically, we see a pop on IPO prices. First day, the average IPO pop is right around 18%. Now, it has been higher in times when the market is very frothy and the IPO market is hot or sexy, like it was in 2020 and like we saw prior to the tech bubble in the late 90s. We saw 60% IPO pop, and there are other times when the IPO pops are barely even there, 5, 6, 7, 8%. The key is the investment bankers want to price the IPO at a price where all of the shares are spoken for and there's enough demand to take all of the shares, and yet they're giving as much money as possible to the company, to the founders that are selling their shares. They want to leave some meat on the bone so that the individuals that are buying the shares in the IPO are actually making enough profit that it is worth it for them to take this risk. The pricing of the IPO is a very, very tough job, and it's something my dad used to do as an investment banker. And it's not easy, because if you price it too low, then you get a huge pop. You end up having an unhappy client because they could have got billions more for their company. If you end up pricing it too high, the IPO falls on the first day and you have upset investment banker and upset clients because they're the ones who bought the shares and they're upset because they're now lost money on this IPO. Very, very difficult game. Now, companies don't have to IPO. They could also do what's called a direct listing. A direct listing is when you take the shares and you actually list them directly on the exchange without having any intervention from an investment banker or institutional investors. You could also do a Dutch auction where the IPO price is not set. Basically, buyers get bid for the shares they want to pay, and the bids get lined up and they get sold at that price. Whoever's willing to pay the highest for the shares are then allocated the shares. But those are less common. You don't see those as often as you see IPOs, but you have seen some of them in the past few years. What happens to an IPO? Well, typically on the IPO, the founders or the individuals that own those shares are going to be locked up for a period of time, so they can't sell all of their shares. Usually that lockup provision might be 30 days or 90 days or even 120 days. They don't want the market flooded with shares to be sold on the first day, because that could potentially cause the stock to crash, right? You don't want that. You want that to be done down the line once the company's had a solid open and a nice little run. Be careful about those lockup dates, because on those dates, if there are millions and millions of shares that are available to be sold, that can sometimes be a day where the market's going to get hammered because everyone's selling their shares. So if you own it the day before, consider whether or not you want to sell your stock ahead of those lockup periods. Now, should you invest in an IPO? Here's the thing. IPOs typically pop on the first day, but can you get access to them? Most of the IPO shares are reserved for the top largest investment firms and their largest institutional and retail clients. So we're talking about the individuals that have hundreds of millions of dollars. The sexy ones, most retail investors are never going to be able to sniff that prior to the shares trading on the IPO. So then your only option to participate in these stocks is to buy them in the open market like everyone else on the day they start trading. Should you buy an IPO and hope to get it on the pop and hope to make a ton of money on that first day? I'd say this is incredibly risky and speculative, because really you have no idea how these IPOs are going to trade. They're not trading on a multiple of sales or a multiple of profit or a value, a book value or anything like that. They're trading purely on a speculative basis that I think someone else is going to pay me more for the share tomorrow or today or next week. And that's a little bit dangerous and a little bit speculative. Oftentimes they go up, but what if it's already gone up a ton by the time you're able to buy it? Well, you've missed that pop. And remember, almost half of the IPO shares fall on the second day. So if you're gonna be trading this, just be very, very careful. My advice to you, if you want to own the company for the long term because you like the company, then do so. Buy it and expect to hold it because you like the company, you want to participate in that sector, you like management, you like the product, you like what they're doing, you think they're a trendsetter, you think they're going to, change the world for the better, and you think they're going to be incredibly profitable in the future, then buy the stock. Add it to your asset allocation, carve out a percentage for your portfolio, 2% or 3%, and leave it at that. Don't trade this stock hoping that it's going to pop 20% and you're going to sell it and you're going to make a ton of money. That's incredibly dangerous, speculative, and you're probably going to get blown up. Anyways, that's my 2 cents. If you want to chat more about this, go to www.speaktorob.com. We'd love to book a no obligation consultation. Thank you guys for tuning in, talking about IPO. I will see you in the next video.